The silver market is sending a message that many investors are only beginning to recognize, and the signal has very little to do with the daily price swings that dominate financial headlines. Beneath every rally, every pullback, and every moment of hesitation lies a much larger story unfolding across the global economy, one that connects industrial demand, geopolitical strategy, monetary policy, and the physical movement of precious metals from one side of the world to the other. While traders often focus on technical charts and short-term momentum, the foundations supporting the silver market are being reshaped by forces that evolve over years rather than days. What makes this moment particularly significant is not simply that silver has become more volatile, but that the traditional relationship between financial markets and the physical metal appears to be changing in ways that could influence price discovery for years to come. Across the world's largest trading centers, signs are emerging that the balance between paper trading and physical ownership is gradually shifting, raising important questions about whether the current pricing system fully reflects the growing demand for actual metal. At the center of this discussion stand two exchanges that have become symbols of two very different philosophies. One is built primarily around financial contracts that provide liquidity, hedging opportunities, and price discovery through futures trading. The other increasingly emphasizes the transfer of physical bullion into industrial supply chains and long-term ownership. Understanding this distinction is becoming essential for anyone trying to make sense of silver's future, because these markets are no longer moving in perfect harmony. They are beginning to reveal different realities, each driven by different participants with different priorities, and those differences may become even more pronounced as global demand continues to evolve. For decades, the futures market has played the dominant role in determining international silver prices. Financial institutions, hedge funds, commercial traders, and speculative investors have relied on highly liquid contracts that can be bought and sold in enormous volumes without requiring physical delivery of the underlying metal. This system has provided efficiency and transparency, while allowing producers to hedge production and manufacturers to manage future costs. In normal market conditions, this approach works remarkably well because confidence remains high that physical metal would be available if delivery were ever required. Yet confidence itself is one of the most valuable assets in any financial system, and confidence depends upon the perception that obligations can ultimately be fulfilled. When investors begin paying closer attention to inventory levels, warehouse movements, and delivery trends rather than simply price charts, it often signals that deeper structural questions are beginning to emerge beneath the surface. Recent developments have encouraged precisely that kind of scrutiny. Although silver continues to trade actively across global exchanges, market participants have observed that available inventories designated for delivery have generally trended lower over recent years, even as overall interest in the metal has remained elevated. This does not necessarily imply an imminent shortage or market failure, but it does reduce the margin of comfort that previously existed. Markets function most efficiently when supply appears abundant and readily available. As that cushion becomes thinner, every delivery cycle receives greater attention, every inventory report carries greater significance, and every large withdrawal invites fresh speculation about where the metal is ultimately heading. At the same time, another story has been developing thousands of miles away. Across Asia, physical demand for silver has continued expanding as governments pursue ambitious industrial policies designed to strengthen manufacturing capacity, technological leadership, and renewable energy production. Rather than viewing silver primarily as an investment asset, many industrial users increasingly regard it as an essential raw material whose availability directly affects production schedules and long-term planning. This distinction may seem subtle, yet it fundamentally changes buying behavior. Financial investors often react quickly to interest rates, currency movements, or changing market sentiment, reducing exposure when uncertainty rises and increasing positions when momentum strengthens. Industrial consumers operate under an entirely different set of incentives. A manufacturer producing advanced electronics, solar components, medical equipment, or electric vehicles cannot simply delay production because silver prices temporarily increase. Contracts must still be fulfilled, factories must continue operating, and customers expect uninterrupted deliveries. As a result, industrial demand often remains surprisingly resilient even during periods of elevated prices. This creates an important dynamic because demand driven by production requirements tends to be far less sensitive to short-term market fluctuations than speculative investment demand. Over the past several years, this structural demand has become increasingly visible as global investment in renewable energy has accelerated. Silver's remarkable electrical conductivity, thermal efficiency, and corrosion resistance make it exceptionally valuable in photovoltaic technology, advanced electronics, power distribution systems, and numerous high-performance applications that support the modern economy. Although engineers continue searching for ways to reduce silver usage through technological innovation, overall consumption has frequently continued rising because production volumes have expanded faster than efficiency improvements. Every additional solar installation, every new electric vehicle, every data center supporting artificial intelligence, and every expansion of high-speed communications infrastructure contributes incrementally to global silver demand. Individually, these applications may appear modest, but collectively they represent one of the strongest long-term demand trends the precious metals sector has experienced in decades. This transformation also helps explain why physical markets have occasionally demonstrated strength even when futures prices appeared hesitant. Buyers focused on securing material for manufacturing are often willing to absorb temporary price increases if doing so guarantees uninterrupted operations. Their objective is not maximizing short-term trading profits, but ensuring consistent access to an indispensable industrial input. Consequently, premiums paid for immediate physical availability can sometimes diverge from benchmark futures prices, revealing subtle tensions between financial pricing mechanisms and real-world supply requirements. These premiums deserve attention not because they guarantee higher prices tomorrow, but because they offer valuable insight into the priorities of participants who actually consume large quantities of silver. Meanwhile, macroeconomic conditions continue adding another layer of complexity. Expectations surrounding the Federal Reserve remain among the most influential drivers of precious metals sentiment. When investors anticipate lower interest rates, declining bond yields often reduce the opportunity cost of holding non-yielding assets, such as silver and gold, making both metals relatively more attractive. Conversely, expectations of prolonged monetary tightening can strengthen the US dollar and place temporary pressure on precious metals prices even when physical demand remains robust. Inflation expectations introduce yet another variable. If inflation proves more persistent than policymakers anticipate, investors frequently seek assets capable of preserving purchasing power over extended periods. Silver occupies a unique position because it combines characteristics of both a monetary metal and an industrial commodity. Unlike gold, whose value is driven primarily by investment and central bank demand, silver benefits from economic expansion through manufacturing while simultaneously attracting investors seeking protection against monetary uncertainty. This dual identity often creates periods of heightened volatility, but it also provides opportunities when multiple supportive trends emerge simultaneously. Looking back through history reveals that silver has repeatedly experienced extended periods during which underlying fundamentals strengthened long before prices fully reflected changing conditions. Markets rarely move in straight lines, and price discovery often lags structural shifts until a catalyst forces investors to reconsider long-held assumptions. Whether today's evolving balance between financial trading and physical demand ultimately produces such a catalyst remains uncertain, yet the growing divergence between these two worlds deserves careful observation. Investors willing to look beyond daily headlines may find that the most important developments are occurring not on price charts but within warehouses, supply chains, manufacturing facilities, and the broader transformation of the global economy itself. Those deeper currents may ultimately prove far more influential than any single trading session or economic report, and understanding them could become one of the defining advantages for long-term participants in the silver market. The importance of these structural trends becomes even clearer when global supply is examined alongside the forces driving consumption. Unlike commodities whose production can respond quickly to rising prices, silver occupies a unique position within the mining industry because the majority of newly produced silver does not come from primary silver mines. Instead, it is recovered as a byproduct during the extraction of copper, lead, zinc, and gold. That distinction is far more important than many investors realize because it means silver supply is often determined by the economics of entirely different metals. Even if silver prices were to climb substantially, mining companies cannot simply double production overnight. Expanding output requires years of exploration, permitting, financing, construction, and operational development, while byproduct production depends largely on whether demand for base metals justifies increased mining activity. This creates an inherently inflexible supply profile that contrasts sharply with the accelerating pace of industrial consumption. As renewable energy investments continue expanding across Asia, Europe, and North America, manufacturers increasingly compete for a resource that cannot be replenished rapidly, regardless of how attractive market prices may become. This imbalance does not automatically guarantee dramatic price appreciation, but it does establish conditions under which supply disruptions or demand surprises can have an outsized impact on market sentiment. Historical commodity cycles repeatedly demonstrate that markets often remain comfortable with tightening supply until inventories reach levels that reduce flexibility. At that stage, even relatively modest changes in demand can produce disproportionately large reactions because the available buffer has gradually disappeared. Silver appears to be approaching precisely that kind of environment, where resilience matters just as much as absolute inventory levels. Investors should also recognize that the physical movement of silver around the world is influenced by far more than simple economics. Governments increasingly regard critical raw materials as strategic assets capable of supporting national security, technological leadership, and industrial independence. Recent geopolitical developments have encouraged many countries to reevaluate supply chain resilience after witnessing repeated disruptions affecting energy, semiconductors, transportation, and industrial commodities. Precious metals, particularly those with indispensable industrial applications, naturally become part of that broader conversation. Nations seeking to reduce dependence on vulnerable supply chains have invested heavily in domestic manufacturing capabilities, while simultaneously securing access to essential materials required for advanced technologies. Silver plays an important role in many of those technologies, including renewable energy systems, medical devices, defense electronics, telecommunications equipment, and sophisticated computing infrastructure. Consequently, strategic stockpiling by governments or large industrial enterprises has become a factor deserving increased attention. Such accumulation tends to occur quietly over extended periods rather than through dramatic headline announcements, yet its cumulative effect can significantly influence physical availability. Another development attracting growing interest involves the evolving relationship between Western financial markets and Eastern commodity exchanges. For decades, global benchmark prices largely originated within Western trading centers before influencing regional markets elsewhere. Today, however, economic power has become increasingly diversified as manufacturing capacity, industrial investment, and commodity consumption continue shifting toward Asia. This transformation naturally raises questions about whether pricing influence may gradually evolve alongside physical demand. If regions consuming the greatest quantities of silver increasingly prioritize direct ownership and physical settlement, their growing importance could eventually reshape market dynamics. This does not imply that traditional exchanges will lose relevance overnight. On the contrary, they remain indispensable components of global finance, providing liquidity, transparency, and efficient risk management. Yet markets continuously evolve alongside changing economic realities. And history demonstrates that price discovery ultimately follows the participants exerting the greatest influence on underlying supply and demand. From an investment perspective, perhaps the most fascinating aspect of silver lies in its ability to respond simultaneously to multiple economic narratives. During periods of strong industrial expansion, demand benefits from manufacturing growth, infrastructure development, technological innovation, and rising consumption of electronic components. During periods of financial uncertainty, silver frequently attracts investors seeking diversification away from traditional financial assets. While gold often dominates discussions surrounding monetary protection, silver's comparatively smaller market size can sometimes amplify price movements once investor participation begins increasing. This characteristic contributes to its well-known volatility, but volatility should not automatically be interpreted as weakness. Instead, it reflects silver's unusual position at the intersection of industrial necessity and financial psychology. Understanding investor psychology is particularly important because markets rarely move based solely upon objective data. Expectations, confidence, fear, and optimism often exert enormous influence over short-term price behavior. During extended periods of economic stability, participants may place greater emphasis on interest rates, employment data, corporate earnings, and currency fluctuations. Yet when uncertainty intensifies, attention frequently shifts toward tangible assets perceived as stores of value. Precious metals have occupied that role for centuries, surviving monetary reforms, financial crises, geopolitical conflicts, and technological revolutions. Silver's historical journey illustrates this remarkable adaptability. It has served as currency, industrial material, investment vehicle, and strategic reserve, continually evolving alongside civilization itself. Today's market therefore represents another chapter within a much longer historical narrative rather than an isolated event driven solely by recent economic conditions. Central banks provide another important layer of context, even though their direct relationship with silver differs significantly from gold. Around the world, many central banks have increased gold purchases as part of broader reserve diversification strategies designed to reduce dependence on individual currencies. Although silver is not accumulated on the same scale by monetary authorities, the macroeconomic environment supporting official interest in precious metals frequently benefits silver as well. Lower real interest rates, elevated sovereign debt, persistent fiscal deficits, and concerns regarding long-term currency purchasing power all contribute to an environment in which tangible assets become increasingly attractive. If monetary policy gradually shifts toward easing after prolonged tightening cycles, investment flows into precious metals could strengthen, providing additional support alongside already resilient industrial demand. Nevertheless, investors should avoid assuming that every supportive factor guarantees uninterrupted price appreciation. Financial markets rarely reward certainty, and silver has repeatedly demonstrated its capacity for sharp corrections even during long-term bull markets. Economic slowdowns could temporarily weaken industrial activity, reducing near-term consumption in manufacturing sectors. A stronger U.S. dollar could create headwinds by making precious metals more expensive for international buyers. Unexpected improvements in mining output or advances in material substitution could also moderate supply pressures over time. Responsible analysis, therefore, requires acknowledging both opportunities and risks rather than embracing one-sided narratives. The strongest investment decisions emerge from balanced evaluation rather than emotional conviction. Even so, when examining the broader landscape, several themes appear increasingly difficult to ignore. Global electrification continues accelerating. Artificial intelligence infrastructure requires expanding networks of advanced electronics and data centers. Renewable energy deployment remains a strategic priority for governments worldwide. Electric vehicle production continues increasing despite periodic fluctuations in consumer demand. High-performance medical technologies, aerospace systems, and defense applications all rely upon materials possessing exceptional conductive properties. In virtually every one of these sectors, silver maintains a competitive advantage that has proven remarkably resistant to replacement. Engineers consistently pursue methods of reducing silver content through improved efficiency, yet total consumption often continues climbing because the overall scale of production expands even faster. This phenomenon illustrates a recurring principle throughout economic history. Technological progress frequently increases efficiency while simultaneously encouraging broader adoption, resulting in higher overall resource demand rather than lower consumption. As these long-term trends continue unfolding, investors may find it increasingly valuable to distinguish between daily market noise and structural developments capable of influencing the next decade. Short-term volatility will almost certainly persist because financial markets constantly respond to economic reports, central bank communications, geopolitical headlines, and changing investor sentiment. However, beneath that constant movement, the underlying relationship between global supply, industrial demand, monetary policy, and physical ownership continues evolving in ways that deserve careful attention. Whether the ultimate outcome proves dramatically bullish, cautiously constructive, or simply supportive of higher long-term valuations, one reality appears increasingly evident. The silver market is no longer driven by a single narrative. Instead, it has become the meeting point of financial markets, industrial transformation, geopolitical strategy, technological innovation, and investor psychology, creating a level of complexity that rewards patience, disciplined analysis, and a willingness to look far beyond the next trading session. As the months ahead unfold, investors should pay close attention not only to the silver price itself, but also to the indicators operating quietly beneath the surface. Warehouse inventories, physical delivery volumes, manufacturing demand, import flows, and central bank policy decisions may ultimately prove far more revealing than a single day's market rally or decline. If inflation remains stubborn while economic growth slows, the Federal Reserve could face increasingly difficult policy choices, potentially creating an environment where both precious metals and defensive assets regain investor attention. At the same time, if global industrial activity continues expanding through renewable energy investments, artificial intelligence infrastructure, electric vehicles, and advanced electronics, silver's industrial foundation may remain stronger than many traditional market models currently assume. The combination of resilient physical demand and evolving monetary expectations creates multiple pathways for silver, each carrying different implications for investors. In a bullish scenario, declining real interest rates, persistent physical deficits, and continued industrial expansion could encourage institutional investors to increase allocations, placing additional pressure on an already tightening market. In a more neutral outcome, silver could continue trading within broad ranges, while physical demand steadily absorbs available supply, gradually building the foundation for future appreciation. Even the bearish case deserves consideration, particularly if a global recession temporarily weakens manufacturing activity or a stronger U.S. dollar limits investment demand. Yet even under those circumstances, the structural importance of silver to modern technology would remain intact, suggesting that temporary weakness may differ significantly from long-term deterioration. History reminds us that markets often underestimate slow-moving structural trends until they become impossible to ignore. Whether this period ultimately marks a major turning point or simply another stage in silver's long evolution will only become clear with time. But the evidence increasingly suggests that investors should pay closer attention to the physical realities shaping this market, rather than relying solely on short-term price action. Patience, disciplined research, and an understanding of both macroeconomic forces and industrial demand may prove far more valuable than emotional reactions to daily headlines. As always, the most successful long-term investors are often those who remain focused on fundamentals while others become distracted by temporary volatility. Share your perspective in the comments below. Do you believe silver is entering a new era of price discovery driven by physical demand, or do you think traditional market forces will continue to dominate? If you found this analysis valuable, subscribe to Gold Horizon and turn on notifications for more in-depth coverage of precious metals, macroeconomics, and global financial trends. This content is provided for educational and informational purposes only and should not be considered financial, investment, or legal advice. Always conduct your own research and consult a qualified financial professional before making investment decisions.